My message today is really pretty simple. When you're developing your business plans and making your presentations, it's not enough to think like an entrepreneur. You need to think like an investor. And so I want to make a few points today, and I'm sure this is the down arrow.
We use the right clicker, right arrow on the clicker.
Oh, the clicker? The clicker. This one, the right arrow on the clicker? So basically three things I want to kind of talk to you about. One, in developing your business plan and your presentation, you want to obviously ask yourself some preliminary questions. We'll talk about a few of those. Secondly, I want to talk a little bit about some of the mechanics of doing the business plan and making a presentation. And third, and probably most important, I want to discuss to you how an investor looks at your business plan, at you, and at the presentation that you make. So, right arrow. Okay, so a well-known guru called Michael Gerber, who's written a number of books, several of whom revolve around a title called the E-Myth, has talked about the fact that before you embark on developing a business, you need to understand the kind of what you're capable of doing, what your team is capable of doing, what your goals and objectives really are, and are you really up to the task? So I'm not going to read through all this list of questions that you ask yourself. What Michael Gerber suggests is you need to ask yourself a set of questions that sort of figure out who you are, what you want to accomplish, what your goals are, can you do it, and do you have what it takes to be able to produce the result that you envision. But the second set of questions are really around, okay, you've had an entrepreneurial seizure, as Gerber talks about it. Do you have a market that you can develop a business for? And you can see a number of questions around here talk about the market and the industry. I'll focus on three. The top one, you really need to understand the market, the industry, the customers, the competitors. If you have a great idea, you need to go into that idea at some depth to be able to explain it. The other point down here in the middle is, what is your go-to-market strategy? If you've identified a customer, you've got a good service or a product, is there a channel development strategy you can develop to make sure you can hit it? And on the bottom line, I was told this by one of the guys that I work for in a corporation, can you describe what the distinctive advantage of your particular product or service is? If you can't, you won't be able to sell it. Because if you can't make these statements and answer these questions, you'll be in trouble when you try to present it to an investor, because an investor will be asking you these very same things. And the third section is really, do you have a business that's investable? In other words, do you have a market? Have you identified a customer? Do you have a concept that's more than, quote, just another technology, to quote one of my good friends? You can have an idea, you can have a technology, but is that going to be something you can produce into a sustainable business? Will it have enough team members? Will it have the ability to be investable? Is it an investable business? Can you interest investors in developing your capital? To be able to do so, do you know what their expectations are? Is there an exit for them that makes any sense? Can you deliver results? The point of these last three charts is you need to ask yourself the personal questions, are you up to the task? Secondly, you need to understand, do you have a product that will resonate with a market and a set of customers that you can acquire? And third, can you develop a business around these ideas that can really deliver them? Just because you have answered some of the questions in the affirmative, it doesn't mean you'll be able to do so. But it's just a set of questions that as you're an entrepreneur, you all want to think about as you get into sort of developing your plan. So we've looked at some of the questions. You've answered them in the affirmative. You determined that you have more than just another technology. What's the process to implement your vision? This chart kind of gives you the idea of how I see the overall process, and it's a bit of a list, right? And I don't want to focus on all of them, but you can see the first couple really are preliminary questions that you've already answered. And as I reviewed this presentation, I changed around the red marks I want to talk about. But the first three, before you get to developing your plan, which is in the middle, is you need to answer the questions we just talked about. But output one is your business plan. So make your plan. You can use it. We're going to talk about that in a minute. But that becomes output one, developing the plan. Output two becomes the presentation that you make from it. And we're going to talk about the investors. And output three is the negotiation and the investment offer, so you get money in the company that will hopefully make you be sustainable. And at the bottom line is every investor is interested in not only what he's going to get out of it, of course, but can you execute? And, and can you negotiate the best deal? I do want to say one thing that most people don't focus on, that's in the middle here, the idea of testing your concept quickly and efficiently before you actually present it to investors. You've heard a lot of articles that talk these days about lean startups. In Mentor Business, we use a concept called lean launch. The concept being try to test your product with a set of customers using minimal resources to get maximum concept about return. Will the customers eat the dog food? So it's got a lean launch idea that should be included in the overall process of which we tried to describe. In fact, I've invested in a company that used a crowdfunding technique in this regard. It's sort of what Travis will talk about, where they actually developed and sold pre-sales of products using crowdfunding. And it's one of the good techniques that works, and it gave us feeling that the customers would eat the dog food if they were presented. Excuse me. So as far as your business plan is concerned, the items on this list are not particularly rocket science, but being a former ship driver and a pilot, I'm kind of a believer in checklists. This to me serves as a checklist of what you're going to include in every business plan. You've probably seen it in most books, most of your plans, and I would submit your presentations too will want to cover these particular elements so you convince an investor that what you have is viable. Let me focus on just the last three. Most plans and most presentations that I see do not have that element of risk and mitigation. I submit to you that your credibility is enhanced when you put that kind of a comment in your presentation and show that you've thought about the risks in your plan and at the same time you've identified mitigating strategies that will address them. It goes a long way toward proving your own credibility and your plan sustainability. The second item down there is status and next steps. Most plans include some sort of a milestone chart. If let's say you're developing a product and you have a new technology, when you're doing that chart, you want to attach to it interactions with other tasks. You want to attach to it time. You want to attach to it costs and people. So show the status of here's where we are, here's where we're going, here's the kind of things that we need to have. Too often, plans and presentations don't have that level of detail. It makes the investor think that you may not have thought through your problem sufficiently enough. And the last one down there, investment opportunity, it's more than just an opportunity. It's really what is the investment offer. The investor wants to know, okay, what kind of cash flow can come with this? What sort of, how much do you want? What are you going to do with it? How long can you survive if I give you this money? Will you need a subsequent investment round to be able to cover that? And how do we go forward from here? So make the offer and also ask for the order. Les talked about selling. What we do as entrepreneurs and as business developers and as people who are presenting to investors is we ought to always be selling. And so you're selling your plan not only to yourself first, then to your team, but to your investors and to your customers. So you're always in sales mode, and you need to think about what that is. At the same time, you need to make sure that you're credible, because that's what an investor's looking at. And I missed a couple of them. Okay. Finding investors. So what I've done here is I've simply listed a group of investors going from the personal out to the more public. And they obviously include friends, family, who are sometimes fools, and we've all kind of been there investing in a business. They include angels, who can be individuals or those in groups, and obviously venture capital firms or private equity firms who are probably a little bit larger and have higher levels of threshold financial targets and specific industries that they're interested, but also public universities and institutions that might be grants. I want to say a couple of things about only three. First, on the top line, for personal assets, investors want to see you have skin in the game. And it doesn't just mean that you operate a company. You need to have contributed some kind of money to it. I've had investors, when I was on your side of the entrepreneur pitching, ask me, so how much money, Steve, do you have in this business? And it wasn't enough for me to say, I'm working full time. It was, how much skin do you have in the game? So in some cases, you might want to try to go to a non-traditional lender. There are banks, it's tough to get loans from banks these days, but there are small groups or friends or even angel groups who will look at lending you money as opposed to investing in terms of an equity structure. And they'll do that with some kind of a security. But it's another thing, another arrow in your quiver to think about when you're trying to raise capital. The second thing is, we talked about angels. There really aren't any anymore. Maybe there used to be, maybe back before the 2000 internet bubble hit, but it's hard to find angels anymore. Yes, we will call ourselves angels, but we all want to see traction. And there's a question of what that traction is, but we all want to see some. So it's tough to find who those are. So I submit to you that early in the process, a third investor type that you don't want to ignore is a strategic partner. Strategics usually are companies that are either serving allied or adjacent markets, and they could be interested in your plan. I'm invested in a company of which I'm on the board of directors that happens to be involved with air conditioning that I know something about, and we have a strategic partner who is not in the air conditioning business. And as we started to make our presentations in different venues, the partner thought, oh, we supply components to what you guys are trying to develop, therefore we'd like to be a partner. We raised a lot of money from that strategic partner, and we're happy that we did. So it's just, think about the investor types you want and then how you can find them. How do you find them? You try to exploit people, and exploit in a nice way. You try to utilize people that are in this room. All of us are either accountants or lawyers or broker-dealers or investment bankers or different kinds of consultants. And they will, in many cases, try to introduce you or make connections for you for free. And they'll also provide services and things for a fee. But on the bottom line, don't ignore people like strategic partners, universities, or government agencies. Another company I've gotten involved in has been able to procure funding from a particular, you notice the alphabet soup down there: Department of Commerce, Department of Defense, Department of Education, economic development corporations here in New York. All the alphabet soups of these institutions, they have money that's allocated to sort of help develop businesses around some of the things you may be interested in. Their objectives are, in many cases, to generate employment and improve their tax base, but they could be potential sources of investment funds that you want to use. So, look, I mean, this is any company trying to raise capital needs to know a lot about the legal and the tax implications of a number of kind of investments. I just tried to put up on one chart just to describe what the landscape is like. There are lots of questions. We can talk about those at some time, or you can talk about them to your advisors. But there are basically three basic forms of investment. Form 1, debt. Form 2, a convertible debt. And Form 3, equity. So, which is some kind of percentage interest in your company. What's the loan the debt holder taking? He's concerned about interest. He's concerned about payment terms. He's concerned about security. The convertible debt is a situation where somebody will give you a loan, but that loan will convert to equity at some point in time, usually with the next financing round. And it's a technique that a lot of angels and small companies to get started use. Basic structures: by the time you make your investor presentation, you will have determined and formed either a limited liability company, an LLC, or a C corporation. S corporations are not used very often these days. A lot of startup companies, I suggest, is a limited liability company because it's easier. However, if you want to have more complex stock arrangements and you want to have preferred stock or common stock, you need to set up a C corporation. Accountants and lawyers can help you get that done. And of course, you can't forget the regulatory environment. I was talking to Stan earlier about how a lot of practitioners, be they accountants or consultants, don't know enough about the regulatory environment and the Securities and Exchange Commission. Most of the financings that we will do as small business people will involve a private offering. And so the SEC has regulations that talk about what's a private offering and therefore exempt from registration, and what are exempt securities that also are exempt from registration. And then these are the sorts of things that you need to be careful of, or your advisor will help you work through when you're developing that offering. The other term down there that I put in red is accredited investors. It's a term that you'll need to be familiar with. It will come up again in the context of crowdfunding. Just because there are crowdfunding rules does not mean that any investor can invest in your company unless he's accredited. And an accredited investor is somebody who has a net worth of over $1 million and annual income of over $200,000. So these are things that accredited investors usually are those who are angels. Now, friends and family can be different, but if you're going to, so the offering needs to be structured a little bit differently when you're structuring to friends and family, and different when you're talking to angels or accreditors. I just wanted to give you kind of an overview of some of the opportunities there. So what does an investor focus on? In my simple way, you can tell I like threes. I tried to group key issues and concerns in a group of three. First is, who's the business and the team? Second, what's the structure? And third, what are the execution and the exit possibilities for me as an investor? And how have you, the company, handled risk? The first thing an investor is going to want to do when you make your presentation, he's going to want to make sure you know the metrics. That is, you need to be able to present them. Who are the customers? How big is the market? What's the accessible market? What's totally available? How will I reach them? That kind of thing. You can go back and use that 10-point pitch that I've actually turned into a scorecard as a way to get at this. Certainly in your projections, you need to have best case, worst case, and most probable case in your analysis. So the investor is going to say, gee, can you really make this happen? How likely will it be if I cut it down by quite a bit? And finally, due diligence. This is an area that I find that most entrepreneurs don't pay much attention to. All of us in the accounting and the legal area do. We've all got good checklists, and they take you through. I see Neil shaking his head. It's exactly what we do. We know how to look at the corporate situation, the personnel situation, the contracts. Most investors don't do it. I submit to you that when you're developing your entrepreneurial package, your plan and your presentation, you think about due diligence. Let me say something about business plans. Business plans are okay as far as they go, but they don't really fulfill the need of what an investor wants in terms of due diligence, and we can talk about that a little bit later. So second big area, okay, what does the investment structure look like? Some key things that investors are always going to be concerned with are valuation, cash flow, and the legal documents that give them their rights. In valuation, I just put down some terms there that will come up in your discussions with your advisors. Normally, if I give you a convertible note, you give me a note, will you give me a discount to the valuation based on conversion? The investor's worried about dilution when new rounds come in. He wants to make sure that for his money, he retains a pretty good piece. Therefore, he's worried about the next round. You guys are focused on getting the investor to do a first round. He's worried who's going to come in after me and make sure that my value will increase at the same time. And what he doesn't want to happen, he doesn't want a down round, which means that he needs to see improving performance of the business so that the next round will actually be an increase in valuation. In the middle area, it's the cash flow section. It's all areas that you probably would think about you need to have for your sustainable business, as Les discusses. What's the time to break even? How long can you survive on the money? What's it going to take for you to be sustainable? What's your role? How will you distribute money to investors? Do they have to wait for an exit event? Will you give them something sooner? And then what's the payback for the investor? What's his return on investment, ROI? And when the investor's looking at the internal rate of return, the IRR, I can tell you this, I've seen very few presentations that talk about the business from an investor's perspective and say, here's what you will earn back over this period of time for your influx of $500,000. So you need to be thinking about what you got to pitch to an investor. Remember my comment earlier, always be selling. You got to sell him about what it is. This is what he's worried about. The document areas, a lot of good lawyers, a lot of good accountants can help you get this done, but you'll see that the documents are not merely boilerplate. Every word, every paragraph in an investment document means something. So if you don't know what it means, you need to make sure your advisor can explain it to you. At the end of the day, that third bullet, the investor wants to make sure you can execute. And I kind of use this 2x stroke 1/2 rule, which means when you show me a graph that says we're going to grow by this much, I'm going to cut, I'm going to say it's going to take 2 times as long and twice the cost. When you show me a hockey stick growth plan, I'm going to say I'm going to cut that hockey stick in half because you're never going to make it. So most investors use this kind of some sort of simple thing to say, hey, look, I got to find a way to cut your projections back. Therefore, go back to what I said up front, up here in this first block. Give them a best, worst, and most likely case, and have some reasons behind why that works. The other thing is, investors really are looking to make an impact. This is not a public company that you go into an angel for. He wants to have a pretty good share, and he wants to know that his advice will be used. So he wants to have an impact. Therefore, think about who you want on your board. When you're evaluating investors, evaluate guys you think might be able to help you with particular advice or particular industries or contacts, because they all want to have an input. And the investor is looking for you to be able to make the tough decisions. And not all entrepreneurs can do that. And even once you take an investor's money and you get them on the board, a lot of them will be pounding you to make winnowing decisions like, who do you cut who was your founding team and help you get the business to this point that you can no longer afford? Not easy being an entrepreneur and doing that, but investors will demand that you do so. So, you've asked yourself preliminary questions, you've got a market, you've developed a plan, and now you've actually put through a presentation. Maybe you've used some of the tools that you've read about or some of the things that we presented, and you know that the investor is going to be looking for what's in it for me. That's really all it's about. What's in it for me? Not how great your idea is. It's what's in it for me, and how long will it take you to deliver me value? Of course, you need to show as the entrepreneur your customer value. He's looking for what value do you give him. So you'll have an opportunity to speak. I submit to you that you want to take any opportunity you can to speak. On the top there, multiple venues for pitches, right? Elevators, the typical one, conferences like this one, cocktail conversations. Think about honing down your investment proposition into a couple of sentences that describe what you're trying to do. You've got to have an executive summary, and you've got to have some kind of that's how pitches are done these days in PowerPoint. You've got to have some kind of a PowerPoint. You may or may not need a business plan write-up to get investment. I know that may sound like heresy, but I can tell you, I'm not looking at a lot of business plans these days. I'll look at presentations. I'll look at executive summaries. We'll, of course, we'll want to talk to the entrepreneur, and then we go into our due diligence, and we pepper him with questions. I was at a presentation the other day where the guy had sent us his presentation in advance. We went in and talked to him. We didn't even pick up the presentation. We sat down with my three partners and I and the founders, and we just talked because we kind of knew what we wanted along the lines that we're talking about here. So you got to have the conversation. You got to have the executive summary, because that gets people. We call it a teaser. You got to have that, and you got to have a PowerPoint. But think about the business plan's probably good for you to lay out your detailed thinking. But to the extent that you do it, it also is supporting of the due diligence process, and that's a good thing. Private placement memo, that only comes up when you have a larger offering. Some PPMs can be small, so you want to talk to your lawyer or your accountant about when you need to do one. Finally, in making your presentations, I suggest that you do a brief beforehand. Get your team together, talk to them. What do we need to accomplish? What's happened before? What are we worried about? And then when it's over, do a debrief. Again, this comes from some of the military background that I have and other people have used. Do the debrief. What went well? What didn't go so well? What could we have done better? What questions did they ask? Where do we not have answers? And that leads to the bottom line. What you want to do as an entrepreneur, actually, my view is in life, you want to ask better questions, because there's always this problem of the unknown unknowns. Step back for a minute. We all know what we know, and usually we can find some way to articulate that, right? We can know what we don't know. That is, gee, I don't know what competitor A is sort of doing in terms of the way he does his contracting, but maybe I can find out. So that's a known unknown. I don't want to use the DOD speak that Mr. Rumsfeld did, but that's a known unknown. The problem is we often don't know what we don't know. And so that's a real concern. You don't know what you don't know. So the way you derive at that is you want to ask yourself better questions, because believe me, an investor will drill down, and drill down until you stop, right? And if you feel it's a bit like root canal therapy, I've been there too. Sometimes I think my partners are doing it to me, but but that's what they'll do. So you want to ask better questions to get further ahead. Finally, Les didn't like this particular chart, but I did. This is what it's all about. In sort of my view is that entrepreneurs have one perspective, the investors have another one, and often there are different sides of the room. When an entrepreneur says, here's my plan and forecast, the investor's thinking, I don't care what your plan and forecast is, I want to show actual results and real traction. When an entrepreneur says, here's my hockey stick growth plan, and believe me, we will all do it. Here's my hockey stick of growth, and we'll be break even by year 3, which is too long, by the way, from the current investor horizon. But the investor says, I don't care what your hockey stick shows. I want to see your executable sales plan. That is, who are your targets? What do they want? How are you gonna get them? If you only have one sales guy, the investor's going to say, not likely that you'll be executable. When you say, as an entrepreneur, look at this cutting edge, innovative idea I have, the investor says, yeah, and you're going to bleed my cash to try to get it done. When you say, what we have is a giant killing idea, the investor says, sure, and you're going to be crushed by United Technologies in trying to bring it out. When you say, look at our great team of focused experts, the investor worries that they're more like academics who have blinders and can't execute. When you say we have all this new idea and energy, the investor comes back to that point that I've tried to make. Execution, execution, execution. Energy doesn't matter. In some respects, passion doesn't matter. Yes, it's important because it generates energy, but you got to execute, and that's what the investor wants. When you put that milestone chart in there and you say, here's what we're going to do with these kind of numbers, the investor is worried that you're going to under-deliver the results that you forecast. So that's what's in his mind. You're going to show something, he's thinking it's not going to happen. When you say, I need these resources to make this happen, the investor's going to say, can't you do it cheaply? You don't need all that SG&A. Find a way to do it cheaper. When you say, the sky's the limit, most investors will say, what are you smoking? Right? And at the bottom line is all this sort of rolls up to you as the entrepreneur correctly need to tout rewards, of course, but you also need to understand that the investor's looking at this from the flip side of that coin. He's saying, here's the risk that you're asking me to take, and you need to find a way to reward me for that kind of risk. So the balance is really the key to all this. So moving forward, let me come back to the 3 points I wanted to make. First, you want to see investors and stakeholders, you want to see the program through the investor's eyes, not just yours. That's axiomatic. You must have the passion and the energy and a plan and a presentation, but you got to target it on what the investor is concerned about. If you have patience and you kind of work through these things and you're persistent in asking yourself better questions, you'll really come out to sort of figure out a way to sort of make this work. So I encourage you to keep doing it, but just take a look at the way the investor pitches it. There's lots of useful references about all this stuff. I mean, building up the plan and the presentation is kind of like, my view, blocking and tackling. You got to have it. But when you're designing the plays that really dazzle somebody, you want to think about how to pitch it to the investor. Take a look at any of the basic stuff that's out there. I think Gerber is particularly good for the first part. I think people like Theodore Levitt, who's written about marketing, are very good for developing a plan. And I think in terms of other resources, people like Les here, the Hudson Valley Center, people in this room, lawyers, accountants, advisors, and particularly websites. The Kauffman Foundation is excellent, as is the National Venture Capital Association if you want to understand investment documents. And angel groups all have websites these days. Go to them, see what they're looking for, see what they're asking for, see what their targets are, see what they demand. You can learn a lot from them. So I end where I began, which is if you want to be successful and raise capital, you got to think like an investor. Thinking like an entrepreneur is simply not enough. Here's what I'll do, though. I'll be happy to give you a copy of the pitch, which I ran through pretty quickly, and I'll be happy to give you a copy of what we use as an investment scorecard to sort of score presentations. Send me your email, contact that. I'll be happy to send it along. Thanks.